Hello and welcome to our recap of our lecture on more adjustments. So we're looking at group accounts and we're thinking what other adjustments might we have to make to those group accounts? Well, remember we need to remove intercompany balances. So what are we talking about? Well, it's amounts that are owed between the parent and the subsidiary because they sell to one another. So the parent might sell to the subsidiary might sell to the parent. Either way, we need to remove the amounts owed. So when it comes to current accounts, the amounts that are owed between the two, we need to eliminate them. We may have a payable in one, which would be a credit balance, and a receivable in another, which would be a debit balance. We need to remove both. They should cancel out, so there shouldn't be too much of a problem in that. However, we may have cash in transit. This is cash that's recorded in one, but isn't yet received in the other. So what we're saying is that the subsidiary, let's say, is selling to the parent. They have sent for the parent to the subsidiary some cash because they're paying for goods that they've bought from the subsidiary. So the parent has recorded the cash going out to the subsidiary. The subsidiary hasn't yet recorded it because it hasn't received it. Well, that cash is missing from the group accounts because it's gone out of the parent but hasn't yet gone into the subsidiary. So what do we need to do with it? We need to add it in. So you want to think of your current accounts as being removed. So we need to remove current accounts, subtract them out, and we need to add back in any cash in transit. So subtract current accounts, add back cash in transit. And we did that in illustration 14. Goods in transit is the same thing. We have goods that have been included in one. So we have goods included in one, but not yet in the other. So they've been sent from one entity to the other. They've recorded as going out of one entity, but haven't yet been received by the other one. Well, again, we need to include those. So we did that in illustration 15. The key thing to remember here is that we exclude current accounts, so just remove them out, subtract them, and we include our goods in transit and cash in transit. So if we've goods or cash in transit, we add them back. We exclude any current accounts. So we did that in illustration 16, noting that if we simply added the goods and cash in transit and subtracted the intercompany accounts, that gave us the correct answer. And the same for illustration 17. We also then went on to look for Perps. What am I talking about here? Provisions for unrealized profits. So provisions for unrealized profits comes whenever we have sales between the parent and the subsidiary. Remember, we shouldn't recognize any profit on these. Group accounts are only interested in profit that's been made with external entities. Profit that's been made by trading with external entities. So we only look at external sales. Why do we do that? Because we need a true and fair view. If accountants wanted to manipulate the profit figure, well then they would sell lots and lots to their subsidiary and recognise lots and lots of profit. But it wouldn't be a true profit because from a group perspective you haven't sold the goods outside the entity. So we only recognise profit on external sales. We need to remove any of that unrealised profit. So how did we do that? Remember we took an example where the parent was selling to the subsidiary for $100. Well, the goods had cost $80, so that meant we had a profit of $20. So we needed to eliminate that $20 because it was an unrealised profit. So we did that in working 5. We debited working 5 to remove the $20 of extra profit, of unrealised profit. Now, the other problem on this was that, remember, goods should be recognised at the lower of cost and net realisable value. Well, the cost of these goods from a group perspective was $80. But now we have them in inventory at $100 because the subsidiary bought them off the parent for $100. Well, that's not compliant with IAS 2. So we need to then subtract it out of inventory. So that's where the other side of our entry goes. So we eliminate the $20 from our working 5 and from inventory to reduce the value of inventory to the lower of cost and net realisable value. Now we only do this with the amount of the goods that we still have in inventory. If they've been sold on, we have realised the profit because we've sold them outside the entity. So that profit has now been realised. So you need to calculate how much of the goods you still have in inventory and use that amount to calculate your unrealised profit. We also then looked at where a subsidiary sells to the parent. Remember, we still eliminate the $20. This time though, if the subsidiary is selling to the parent, we need to think about where the $20 is. Well, we've got the profits share for the parent in working 5 and the NCI share in working 4. So we need to remove a little bit of the $20 from working 5 and a little bit of it from working 4 in the share that we have of our profits. So parent share working 5, NCI share in working 4. And then all of it is credited to inventory. Remember, that's because the parent is not selling to the subsidiary in this instance. If the parent was selling to the subsidiary, then all of the profit would be in working 5. This time the subsidiary is selling to the parent. So in the subsidiary we have the parent share and we have the NCI share. So we need to remove the unrealised profit from each of those. Remember, when calculating the unrealised profit, you need to check whether it is a markup. And if it is a markup, you'll multiply the unsold inventory by the markup percentage over the markup percentage plus 100. So if it was a markup of 50%, you would multiply by 50 over 150. And if it was a margin, we simply multiply by the margin. So if the margin was 50%, we would simply multiply by 50%. Lastly, we just mentioned non-current assets. Again, we may have perps on non-current assets. So if the parent was selling to the subsidiary and made a profit on a sale of a non-current asset, we would need to adjust the asset, reduce the value to take away that bit of profit that we'd recognised, and move the perp. So the perp would be removed in working 5. The only difference would be that we would need to adjust the depreciation charge for the new value of the asset. And we do that in working 5 because there would be less depreciation required. Lastly, if the subsidiary was selling to the parent, sold a non-current asset and had a profit on it, well then we still adjust the asset, but we need to split up the perp. So the working 5 would be debited with the parent's share, and then working 4 would be credited with the NCI share. So we'd adjust the depreciation in working 5 for the parent share and adjust the non-controlling interest in working 4 for the NCI share. Also, don't forget that the share of the depreciation adjustment would be split out between the two as well. So that was a recap of our lecture on more adjustments.